Surging interest rates, the yield on the 10-year Treasury hitting a fresh high of 4.7%, highest level since 2007. Let's bring back Rick Santelli, who's here with us in studio, along with Chad Morganlander, Senior Portfolio Manager with Washington Crossing Advisors. Gentlemen, good to have you both here. A couple of things struck me over the weekend. One was a very interesting article in the Wall Street Journal that compared the performance of the S&P 500 cap-weighted versus the unweighted S&P 500, and it was shocking. The only way you make money this year in the S&P is if you're in that cap-weighted index, not in anything else. Number two is the rise in interest rates to where they are right now. This reminds me spookily, eerily of 1987.
I can't disagree. And there's some of the similarities are the speed at which markets are moving. I always like to look at the slope of the increase on rates. And they're guns hot right now. So we're almost getting what I call the staircase, where you're looking at higher closes all along. Now, the previous high yield close, I believe, was the 27th of September at 461. So we're going to have a new high yield close for this cycle. And I concentrate most on the closes. I think the other similarity is with the crash that the equity markets, you need to view those in the context of interest rates. And the one big difference is that we conditioned people in the crash. I was trading in the pits in Chicago during '87, is that the minute the stock market started to go down, of course, interest rates started to go down as well. And Kelly's pointed this out a number of times, that what we have now is almost the worst of both worlds. You have a squeamish stock market, and you have rates climbing aggressively. Now, granted, rates ultimately did have a move that appeased the conditions of the day. But I think with the debt level rising the way it is, I think this one is going to be higher for longer, meaning Fed and the market-driven rates are going to share that similarity. I really do think there's a chance rates at these levels are going to balance out, but I wouldn't look for a huge correction.
A huge correction in rates, or in rates? In rates, yes. a huge return down. What is you just heard what Rick said, you heard what I said. What do you think of equities right now, here, between now and, let's say, the spring?
So it could be a bit challenging because the risk-free rate is around 470, and then you have the T-bill rate at 5.25. You have a PE multiple forward-looking around 18, 19. So you reverse that, you make that into an earnings yield, and it becomes a little less compelling. That TINA trade is gone. Stick a fork in it. And I agree with Rick, higher for longer is certainly going to happen. But overall, we do think inflation trends are starting to moderate. There are seams of opportunity now, in particular, because of this concentration of the big tech stocks moving higher, distorting the overall markets.
It's funny you say inflation, because that feels like an easier concern than what we're up against now. I can't even believe I'm saying that, but it feels a little easier to solve inflation because at least the Fed can act. Trying to now solve these yawning deficits, which the government has to solve, and the only thing that could bail them out of this is literally a financial crisis where rates crash or the Fed starts buying bonds again. This feels like even more challenging.
Without a doubt, you're going to have a deficit that's going to be continuing to be historically high with the CHIPS Act, the Infrastructure Act, and whatnot overall. But we think that right now that if you just prepare your portfolio with good quality companies that are not over excessive in regard to valuations, that have very little debt, that are very consistent. So look at consumer staple companies, Colgate, Clorox, for example. You could look at Accenture.
It's funny you say this about staples, because one of the debates going around in the market is whether the Mag 7, to Tyler's point, are the new staples, right? Like, I would rather cut back on my toothpaste than what I'm spending on Google every year because of my photo collection of the kids, right? Like, which one is really stickier? Which one is really a staple? And does big tech represent those new staples? Is that why you could have exposure here to make the argument?
I think big tech is reasonably valued, certain parts of big tech. I would not go and stick my neck into NVIDIA and whatnot, but you can look at big tech like Microsoft, Google, as well as Accenture for reasonable valuations. But I will also suggest that looking at a Hershey's, a Clorox, or a Colgate, they're now reasonably priced, and they have very little debt, and they have lower beta, lower volatility.